Very
Well,
good.
welcome everybody. We are here in our first Wisest session about how do you plan your finances and how to make better financial decisions with the Wisest team. I'm Alejandro Satapolsky. Welcome to those seeing us live and welcome to those seeing the recording. Um, we're gonna do about 20 minutes of questions and answers from our experts. And we can take your questions in the meantime, so feel free to just put them in the chat if you are seeing us live. And if not, just reach out to us, go to wisest.com, and we'll be able to answer any questions you have. Today I'm here with Lázaro Gonzalez, who is the co founder of Wisest, and Estivalis Inser, who's head of investment and chief of staff in Wisest. Hi, guys.
Hi, thank you for having us.
No,
Absolutely.
thank
Glad to be
you.
here.
So why are we here? So we want to have this chat because in times of uncertainties such as these, it is essential to make informed and responsible decisions about your finances, right? And uh, for us, that requires to set your specific short and long term goals and also get expert advice to guide you along the way. So we will discuss how you can make better decisions planning your finances and finding experts to guide you along the way. Um, let's start here. So, I am a first time investor. I want to invest in the markets, but I'm not sure where to start. How do I go about it? Esti, do you want to go first?
Absolutely. And thank you for the question, Alejandra. Yeah, so investing is a very personal decision, right? And in general, relationship with money, it's very personal. It's different for different people, right? Um, Depending also on how you grew up, so sometimes you see money as a way to protect yourself, for future events. Some other people see money as a way to, for happiness. It can give me happiness if I go on a trip and things like that. So different people have different ways to look at the money. But let's start looking at the investment journey, right? Again, you have to have a plan, a strategy, and we'll talk about that later. But generally speaking, you have to look at yourself, right? What's your financial situation? Where are you in your life? What's your level of income? Um, how much can you set up some money for investment? Do you already have like a savings account or something set up for like an emergency fund? And I would say, that probably a good idea is to start there if you don't have one already. Then obviously, when you think about investing, there is always risk to investing, right? And you look at and you hear, the news on the markets go up and down, and that's, has a lot of volatility. So how or to what level of risk would you be happy to have, that's or you're comfortable to have? That's a very important questions to answer, as to, when you decide when and how to invest, what to invest in. Then what's your objective? So different people have, as I was saying, different objectives. You might be a senior person that is investing just to get additional income, or you might be, a person who's just starting to work, and then you want to save for the future, for retirement. Um, Again, different objectives, and then different time horizons. So once you answer those questions, and maybe you get some help from a financial expert in doing that, and we'll talk about that later. But so there are different avenues to invest. Okay, so what do I invest in? You can do it yourself, and there are several engines out there, or online brokers that give you the possibility to do that yourself. You can start, you for sure you have to start understanding the markets and understanding what are you going to put your money in. So you maybe continue to do it yourself, and you start reading, you listen to the news, you get some financial newspapers, and you do that due diligence. Another avenue is obviously, you can look for an expert, a financial advisor, and that person would be the one to go to get advice, and that person would guide you in answering all of those questions that I was covering at the beginning. Then also you have some other options like robo advisors that are out there, and then you answer these questions electronically and they present you with a portfolio. But usually those don't have the human interaction, which
Right.
most people
Right.
really appreciate. So different answers depending on the person, on the personal situation, on your relationship with your own personal finances. um, but
Yeah.
yeah, there we go.
And Lazaro, I know you started Wisest with that in mind too, that, you, well, the co-founder too, come from the wealth management industry, and you saw that, first time and smaller sized investors sometimes find it harder to work with an advisor. So how was the story, and why did you come up with this solution with Wisest?
Yeah, that's I wanted just to that point is one of the things that we found was a not a solution where people wanted to invest, but they just didn't know exactly where to go. And sometimes it's, you don't know where to start. You don't know who to trust. Some of the preconceived notions where advisors are going to sell me something where they're going to make money off of it, or I can go off by myself and sell something. I can go and trade by myself, like some of these other platforms. And we wanted to build something that was like, we'll help guide you. We'll help you along the way. Like we'll get this thing started for you. We'll show you what advisors are doing themselves, and then you can replicate it and then also teach them, right? It's not going back to that teach a man to fish thing where you teach them how to do it, and as they go along they feel more confident, they feel empowered to do it themselves, they know what they're looking for. And that's really what drove us to start it, right? We were seeing people that just had money, they wanted to invest, they just didn't know where to start, and that's kind of what led us on this journey of building Wizest. So that was something that we're very proud of, and we want to make sure that we can emphasize that to our users, that we are going to show them how this works as they go through the journey.
So, you gather these team of experts, right? Who are they?
So some of the experts have, so we basically put together advisors that have, they're certified, right? They have they're certified, they have credentials, they have been in the industry for a while, they do go through a vetting process as well. And then we start asking them to build certain portfolios. And it's not portfolios where they get incentivized on, but it's portfolios as if they were their own personal portfolio. So they're building a portfolio for themselves. It's performing to how they think is best for them. And then users will come in, see that performance, see the ratings from other users at, oh, I've had returns, 5-star rating. Users will see it and then they'll say, I want to replicate that same exact portfolio for myself.
That's like social investing, right?
Basically, yeah, that's
Yeah.
what we're for.
But let me add something here, because like generally speaking, what would you look at, or a general investor would look at, if you're talking to an advisor, let's say a human advisor, a person. You want to make sure that this person has the proper credentials, right? The education, and also, again, I was going to the personal side of investing. Uh, this is a very personal and difficult situation for most people. Where to invest, how to trust that person that is guiding you on this journey. So that you have to really do your due diligence in finding that person, right? That person that's gonna be your friend at the end. His the person is gonna know your personal finances, your situation, what your goals are, your dreams in some cases. So you have to have that and develop that personal relationship with that person. And at the end, you're going to find that there are some financial advisors out there that tend to go to certain industries or styles in investing that might not be appropriate for you. So really, you want to look into that also. There's a good, obviously the whole industry is very highly regulated. So The regulators have there's a website where you can go there and look for, advisors and see, what their history is, their credentials, if they're registered, if they're not. So I mean, if people are interested, they can go to broker check and look that, hey, somebody, a friend of mine told me this name, the name of this person. Maybe, we want to check there, if you're dealing, with with the person that you want to deal with at the
That's
end.
a
So
really good tip. Yeah. And now also, how do you decide whether you're ready or not to start investing? Right now, the markets are very volatile. Everybody is sort of scared off. Um, um, what do you consider is the best moment to start, or in terms of being ready, um, how much should I start with? What boxes should I check before starting my own investment strategy?
So, investment strategy again. Let me take that. And You have to have a plan. And again, going back to looking at your own personal situation, can you invest? And this question, I mean, you have to look at five different things here, because when you look at the markets, or investing in general, there are things that you cannot control. You cannot control if the markets are going to go up or down today or in the next month, right? You cannot control where the economy is going to go. I mean, we had a second quarter of GDP decline. Technically, that's should be a recession, or could be a recession. That's the definition of a recession. But there are other aspects out there. Um, I would argue that whenever we have these corrections, um, you know, it might present an opportunity. But again, it
Mm.
depends on your time horizon. If you're looking to invest just for 1 year, maybe, then you have to think about what to invest. Maybe more conservative instruments, not too risky instruments. But if you're looking in the long run, I mean, and maybe last you can put a slide. I had put a graph there where, you see that clearly the trend is upwards. Markets recover. So, and one thing you have to take away when investing is emotions, or minimize the emotions. But because when markets drop, and you are invested, the first thing that comes to mind, to some investors' mind is let's liquidate. I don't want to. I can't stomach, the risk.
Yeah.
And then that's where, the guidance is very, very important, because an advisor, could keep you, have things in perspective, and looking, hey, you know what, you have a plan. Your plan is you're investing for the long run, you're investing for retirement. And if you have like a consistent plan, let's say you set aside, I don't know, whatever it is, $20 per month. You're putting that into your fund, right? And that's, getting also the compounding effect of growth, of time as well. So here you can see, I mean, this is the price of the S&P during the last 20 years. As you can see, yeah, we've had up and downs, and that's the market. That's the market that you cannot control. You cannot control a political event like the one we had the war in Ukraine this year. You cannot control that. But things that you can control for sure is how much you spend. Because if you have $100 and you spend the 100, you don't have anything for saving, right?
Hmm.
So how much you spend, how much you want to save, for what exactly you want to save. You want to save for, like I was saying, to go on a trip, or you want to save for the future. You want to save for just getting additional income. What is your objective? Then how much risk can you tolerate? And going back again to those personal questions that you have to answer yourself in deciding what to invest, and when to invest. Now, when to invest, um, last, if you can go to the next, I think it's the next slide, the one that has a, yeah, here, for example. It's a busy graph, but let's focus on the blue line. The blue line, when you see these drops here, like the first one, you see the recovery. And kind of the gray area is where we have had recessions, right? So if you're afraid that maybe we're getting into a recession, something like that, um, I would argue that, yeah, markets would drop, but then they would recover. And if you didn't take that opportunity, you're missing some, to get some additional return on your money. So the thing I would say is, consistency.
Yeah.
Consistency in putting, if you have decided to save, put some savings, $20, whatever you want to save per month. Try to make it a habit. uh,
Yeah.
because you're gonna get, yeah, at some point you're gonna get the downturns, but also you're gonna get the
The
upsides and the
upside.
compounding effect of that. So it is very important. And the
Yeah.
last one, I'm sorry.
I mean, in that sense, what the best advice I heard was first put it on a recurrent withdrawal without even thinking about it, like an expense. And also, if you don't like, whenever you have the drop, which is when every first time or an investor that doesn't have that much time in the market gets scared. They're like, oh, there is this drop. I lost that money. And if your time horizon is long, you haven't lost it yet. If you don't withdraw, you're not realizing the loss, which is a very important concept that everybody has to understand. I think when you're starting to invest, yes, the market will go down, but it can
Yes.
recuperate. So unless you have a life event in which you need the money, don't take it out, because we know that in the long run, throughout the years, you will come out winning, which is what you are saying.
And exactly, I mean, that life event, precisely what I was referring to when I said at the beginning, if you have already have or don't have an emergency fund. And really, the rule of thumb, I mean, um, again, it goes back to the question: what do you feel comfortable in having? Perhaps the rule of thumb is at least 3 months of income. So you
Yeah.
have that saved, not invested, but just saved for an emergency. And it's very important, because that's going to give you confidence or comfort to have then your investments growing, going up and down. But again, depending on your risk level.
Yeah.
And yeah.
And I would love to go into with Lazaro about the different types of platforms out there or solutions for investments, because we just spoke about it very briefly about, okay, you should go to an advisor, but it really depends on how much money you have to invest. That many advisors require a minimum investment, or there is robo advisors out there that are targeting a lot of first time investors. Then you have the issue of cryptocurrencies. There is so much out there. And I think that this overview is really good. So I wanted to go over that.
You're on mute, Les.
No, sorry about that. I didn't realize that. So there are a lot of different solutions there, right? We do have the I want to do it myself. So that's where you go to those trading platforms and you select the stocks. I mean, we have some of these popular fintech apps that were doing that. And then you also have the other extreme, which is just do it for me. Like, this is how much I have. Go ahead and invest it for me based on some sort of algorithm or some sort of, human intervention, which are the advisors that are doing that for you. What we wanted to do was build a, like a center area or a little bit of both, where it's like, do it with me. So, you have a little bit of that self direction where you can create a portfolio yourself, or you can have some of the automated, portfolio creation. But we wanted to do it like a little, where you can say, this is my risk tolerance, this is how much I have, and this is how much my time horizon is. Like, I want to see best performing portfolios that meet my criteria, and that's kind of where we wanted to fall into the landscape of all of the different investing platforms. So it's just something that we take into account how comfortable you are, how long you want to be investing for, and then show you recommendations based off of that. Going back to Este's point, it's we wanted to create something where you are comfortable investing whatever amount you want to do. If you want to start off with a little bit and understanding, how it works, and then build a portfolio, get comfortable, and then you want to start adding funds, you can do that here. But it's really going to come down to how comfortable a user is putting money in it, not having to withdraw it, so they can really reap the benefits of it. One of the things that we're seeing in this downturn is that some of these higher price stocks, for example, like the Apples or the Googles, have fallen from a price perspective. So it's actually a good opportunity to get in and get it at a lower price. Will it still fall a little bit more, yes, but you have an opportunity to get in so that when it does go up and it does start, getting a profit, you can reap some of those benefits. So I would actually say that at a time like this where there is some sort of volatility and prices are falling would be a really good time to get in and get it at quote unquote like a value or bargain price, if you will, so that when it does go up, you can really start seeing some of those benefits.
Amazing. And where do you think how I'm sorry, you were talking about before that there are several different options that we're talking about, but I wanted to go deeper into those options because for people who do not understand what those options are, I want to make sure that we see the pros and cons, right? So we do have the self-directed platforms in which you have to learn a lot, right? You have to make sure that you know what you're buying, and for that you do have to go deeper into what a stock is, what ETFs are, what the funds are, and basically study them all, right? And then the on the other spectrum, I don't know where the minimum is to meet with a financial advisor that will do it everything for you, right? Or the robo advisor that does, everything for you too, but you're not sure what you're buying, right? So what are the
Exactly.
pros and cons there?
So the pros and cons with the automated or the extreme of like do it for me is that you have experts building this for you. And then the cons to that is, money is something that's so personal and everyone has a different value for money, right? So like think of when you're checking your bank account on your mobile phone, like that's not something that you would sit at a park bench and like everybody walking by would see. That's something that you tend to like keep close to yourself and you don't really like to share that type of information. So that when it comes to that, like people would like to have some sort of control or have some sort of input on what they want to invest in. Like if they don't believe in certain practices or morals that a company has, they may not want to invest in it even though it has those great returns. There's a certain price that you pay with that, right? So that's the con, I would say, of having this fully do it for me setting, right? And then when you have these self-directed instance where it's you, like you said, you do the research yourself, you find stocks, but then you're also relying on people on social media or on the news or anything like that where they could be pumping up some sort of stock or they could be downplaying something, right? So you're really like, do you really know who you're getting that information from? Like, is there an ulterior motive to having that sort of information out there? You don't know that yet unless you really trust that person. So those are the pros and cons, I would say, to the do it myself and then like to the have it for me. Like you just don't have that interaction or that guidance or the influence on how you want your money to be invested for you.
And everybody speaks about diversification, right? And we talk about it a lot. What is it? Why do we why do we keep pounding on that?
So diversification is key to any investment strategy. I mean, and it's a way basically to lower the risk of any investment strategy. And what happens is different asset classes, because we talk about asset classes. Stocks are an asset class, bonds are a different asset class. Um, so different asset classes have different level of risk of different ways they move. Stocks historically, move wider, and they drop more or increase or have higher returns than bonds. So historically speaking, bonds tend to be more conservative than stocks. So it depends on where you are on your level of risk. Again, you can be more conservative toward bonds or more aggressive towards stocks. And why that is important? In any given year, you can have one asset class that is at the top of the return, and then the next year is at the bottom of the return. And last, maybe you can put that kind of periodic table that I like to make reference to, that shows why exactly this is important. And it's a little bit busy, the graph, but I mean, most people will get it. Again, if you look at this table, just look at the colors, right? In any given year, one of the colors can be at the top. The next year, it can be at the bottom. So the line or the white spots are what is called a balance or an asset allocation portfolio. So a balanced approach to investing, which is a mix. It's a diversified strategy, basically. It includes bonds, stocks, different assets in a mixture that goes in line with your own risk level. So in this case, usually a balanced portfolio, like a regular theoretical one, the most used one is 60% stocks, 40% bonds. So that's kind of the rule of thumb, right? That portfolio, if you can look here, in any given year, is not going to be at the top of the return. You're not going to, hit it out of the park, but you're not going to lose as much as 30% as the market. So you're going to be in the middle, in between, right? And also the volatility or your level of risk, which is the right hand, the column at the right hand side, the volatility or how that portfolio is going to move, it's going to be at the lowest level. Well, not the lowest completely, but one of the lower levels. So your risk return proposition becomes more attractive to most investors. And this is exactly, the power of diversification. Basically, to get a decent level of return by lowering the risk of your asset mix.
I'll give a quick, simpler answer. Like, just think of Bitcoin, right? Like, Bitcoin was going through the roof at one point. It was, 20,000, 30,000. It went all the way up. Now, imagine having all of your life savings or your assets invested in Bitcoin, for example, where it's at the top, and then all of a sudden it's where it's at right now. Like, you will not. That's a tough pill to swallow, right? Especially if you're thinking about retirement and you put everything into that one asset, right? So what happens if you, instead of going all in on Bitcoin, you would have done either different coins or like different stocks, right? Like, same thing with Apple or with some of these other tech stocks, or, energy right now is booming, right? But so what happens if you would have had everything in a tech stock versus in some of these energy focused stocks, right? Like in different sectors. Like, if you would have had those things, you would have some hard and steep ups and downs, right? But now if you have a diversified thing where you put a little bit in a growth asset or a little bit in a ETF or an index fund or something like that, like, those ups and downs aren't going to be so hard on your financial portfolio or on your end game if you were to have a sort of variety, right? So that's how I would answer that question. Is it's always good to have variety, because you may not get the top or the best performance, but you also don't want to be left holding the bag when things are going down and like you're all in on this thing, right? Like, I want to be able to spread it out a little bit more and even my odds if I could. That would be my approach to the diversification of the portfolio.
Good, great. So we're running out of time, but I wanted to close with basically, what are your top 3 tips, or what recommendations would you give to someone that's starting to invest? What are the 3 main recommendations you would give?
3 recommendations I would say are, understand, like, do your due diligence, not just take it from one source there's not one source of truth, right? Like, always look at it from different perspectives. Do a little bit of homework in exactly what you're investing or who you're investing in, right? Make sure that you have funds that you can put aside and you're not going to rely on in case if you have some sort of emergency, right? And then the third thing I would say is be patient when it comes to stocks. I know it's hard to hear, especially given that money and investing is so sensitive and there's ups and downs. The more you sit on it and you look at it daily, hourly, the more it's going to hurt you, right? Just think about what your long-term game is and what your end game is. Like, are you comfortable walking away at a certain price point? So if I buy something for $1 and I'm like, okay, I want to walk away at $1.50, it doesn't matter if it gets to $3 or $5. Like, you've made what you wanted to get out of it at that point. Don't try to get greedy and take it all away, because there will be a decline at that point. So understand your end game, on how much money you want to invest or how much you're comfortable with, and then just do your due diligence would be the 3 things that I would recommend when it comes to investing.
Great one. Steve?
I was just, summarize and have a plan and don't panic. If you have a plan, you know what you're doing, probably with the guidance of an expert, understanding yourself, obviously, answering those questions that we talk about during the webinar. And yeah, don't panic. I mean, stay calm, and markets, have up and downs, but understanding your personal situation and having a plan, will help you manage the volatility, basically.
Right. So don't go with the news, the news
Right.
cycle, basically,
Yeah,
right?
turn off the
The news.
the TV. or
Exactly.
the leader.
It was very, very informative and fun. Thank you so much. And we'll see you next time. In the meantime, just um, feel free to reach out to us through any of the channels that you're watching us on, and or check wisest.com. Thank
Thank
you,
you.
Lazaro. Thank you, Esti.
Appreciate
Thank you
this.
so much, Alejandra, and thank you everybody for listening.
Have a great weekend.